Well, this is going to be a controversial topic. Why you should not buy mutual funds. We're also going to cover what you should buy instead. Hey, consider subscribing to this channel. We make good content. So on today's agenda, we're going to talk about the historical market performance, fees associated with mutual funds, the real cost of mutual funds, and what you should buy instead of mutual funds. Here's a really quick risk disclaimer. So let's first look at the market performance. What we have here is a chart of the S&P 500 index. This is used as a standard benchmark to measure the overall stock market performance. We're going to look at about 20 years of history. So we're going to go back to from around 1999 to 2019. And if we do that, this is what the performance looks like. Here I have the years ranging from 1998 to 2018. The percent gain or lost in those years, and then the account value, assuming that we start at the end of 1998 with a $10,000 account. So if you look at this right-hand column, what you'll see is that that $10,000 starting account value would have appreciated to $29,837.26 by the end of 2018. This is a total gain of about $19,837.26 in 20 years. Just using the S&P 500. So if we were to invest in a mutual fund, we would get the same return, right? Wrong. That is because of mutual fund expenses. Those are expenses like broker commissions, expense ratios, capital gains, transaction costs, and they typically come in at about 3.75% a year. 3.75%. So let's go over broker commissions. This is the first one. This comes out typically on the front end of you making an investment, but annually it continues to come out of your account even though you don't see it, at a rate of about 0.25%. Brokers getting paid. Then there's the expense ratio associated with actually running the mutual fund. Typically there's a chartered financial analyst at the head of every mutual fund. Maybe a couple of these guys. These guys have to get paid, as well as fund managers and everything else. Typically this comes out at an expense of about 1.25% annually. Next, we're not talking about taxes that you will pay. These are capital gains taxes that are incurred as a result of the fund actually selling some of its holdings throughout the year. So when you sell holdings, you're subject to capital gains tax. So even if you hold the fund and you don't sell, the fact that the fund manager sold assets within the fund could mean that they incur capital gains, and they do every single year. So where do these capital gains come out of? You guessed it. It comes out of the fund. They don't pay this. You as the investor pay this. Lastly, there's transaction costs. So rebalancing portfolios, making new investments, getting rid of old investments, all of these rack up transaction costs. Typically this comes in at about 1.25% annually, and this makes up the average mutual fund load of about 3.75% per year. So what does this mean, 3.75% per year? Let's go back and look at this S&P 500 return. So at 3.75% per year, we're going to take the gain and loss and reduce it by 3.75% fees. This is what happens. So the S&P 500 return, we have it highlighted here. At the end of 20 years, you would have a profit, a net gain before taxes of $19,837. But when you add those mutual fund fees to the same movement, you end up with a mere $4,291.16. $15,000 difference. $15,000 difference on an initial investment of $10,000. Pretty substantial. This is what the chart looks like. S&P over a period of time from 1998 to 2018. This is what we're looking at here with the green line. The red line is going to show what you get after all of the expenses associated with the mutual fund doing the same thing. S&P versus a mutual fund. It's not as good. So what should you buy instead? Well, how about an exchange traded fund or an ETF? We'll use the SPY ETF as an example. This can be purchased like a stock online, very low annual expenses, offers higher liquidity, it's a mirror image of the S&P 500, and it is optionable. So The SPY ETF is just an exchange traded funds that models the S&P 500 return. So if we pop up the S&P 500 return one more time, we've seen this multiple times now, we're going to pop in our mutual fund return after having those annual fees. So we have the $19,837 return here on the S&P 500, and then we have the $4,291 return on the mutual fund. So where will the SPY ETF come in? Well, the SPY ETF is going to come in at $19,315.03 because it does have some minimal fees associated with managing the fund. But the rest of those fees are not associated here with the SPY return, and you can see that it trumps the mutual fund return significantly. So let's go back to this chart. If we have the S&P 500 charted here with the green line, starting in 1998 to 2018, again we have our mutual fund return substantially lower. What we're going to find here with this yellow line, which is our SPY, is that it is almost a mirror image of the S&P 500. This is your best option. So here's some bonus content. How do you actually buy an SPY ETF, or any ETF for that matter? Well, it's easy. It's 3 steps, and this is all you have to do. First, you open up an online brokerage account. You type in SPY in the order bar, and then you purchase at the current ask price. Hey guys, don't forget to subscribe. We make content like this all the time. Click that button now.